afternoon for this webinar regarding how to attract investors and funding. We have two of our supporter companies for our Entrepreneur Foundation delivering this particular session. So we have Emma Cameron, who is a corporate partner for VWV, who are award-winning lawyers, and we have Chris Platt, who is Director of Credit and Underwriting at Redwood Bank. So welcome to both of them. Just a couple of housekeeping notes just to say that we are recording the session. We will be supplying a link to the slides afterwards as PDFs from our website. And if you do have any questions, if you can hang on to those thoughts and perhaps put them into the chat function, and then our speakers will get to them after their presentations. So we'd be very grateful if you would do that. So without further ado, I am going to hand over to our speakers. I believe Chris is going to be speaking first, so I will hand over to you, Chris. Thank you so much.
Thank you so much, and thanks for inviting me along today. Good afternoon, everybody. So I've got a very wet Essex today, and I've got a dome above me where rain has been hammering for the last hour. So I apologise if there's a bit of background noise. Some of you will have heard the presentation a couple of months ago from my colleague Leon Markwell, who's Director of Business Development at Redwood, on secured debt. Today I've been asked to look at external investment and how that can support an impact on a business. Some of you will undoubtedly have had hands-on experience, and greater than I, of investors and investment. But the slides here cover my thoughts and views, and I would say right at the outset, I'm not a tax expert. And one of the things I'll be talking about is just a scheme which supports and helps investors from a tax position, but I'm not a tax expert. So you've got, if I could go to slide 2, please. That's on. Thank you. Just a very little bit about me. I'm a career banker, ex-RBS NatWest. Through my career, I've been both a frontline relationship manager, dealing with a full range of businesses from very small business, startups, SMEs, up to corporate and FTSE quoted clients. I've met and supported many entrepreneurs in my time with debt. I joined Redwood Bank, who are based in Letchworth, in 2017, at the point it obtained its initial banking licence, and I was number 8 employee, and we've now got over 110 employees. We gained our full licence in August 2017 and drew our first loan down in September 2017. And that transition from partial licence to full licence was one of the quickest that's been undertaken by a challenger bank. Bit about me, I've got a couple of grandkids, Lena age 4 and Austin age 1, a son who's a school teacher, and I've also got a daughter who's a cabin manager at EasyJet, but she's obviously furloughed in these current circumstances, unfortunately, but working for the NHS at one of their vaccine centres as the front person in Harlow. So if we could go to the next slide, please. Just a brief run through just about Redwood Bank. We are very much a secured lender, lending to professional landlords of buy-to-let properties and commercial investment, and also to business owners through secured loans on properties. So we would support businesses purchasing their properties. Number of awards that we've won over time. We recently passed £350 million of lending. From a customer satisfaction perspective, that is really high on our deliverables, driven by our values of integrity, certainty, tireless and simplicity. Those 4 values are pretty simple, but ones which we follow with product launches, process changes and customer interaction. And the awards that we've got in a short space of time, to be honest, since we've started, really are really follow that customer satisfaction and the way that we deal with our brokers as well. If I could possibly move to the next slide. Thank you. So as a business, investors or debt, let's look very quickly at the advantages of debt and the disadvantages of debt. So if you take out pure bank debt, with a lender. It's non-dilutive to shareholders and founders, and the lender's interest is generally restricted to the return on the loan, i.e. the interest paid and obviously some fees. But the shareholders, founders, management retain 100% control. Speed of decision sometimes can be far quicker with existing funders who can provide decisions based on previous relationships. I think over the last couple of years, certainly through COVID, certainly the big five have struggled with that on the basis they've been supporting C bills and B bills. So speed of decision is often key for businesses, as we know. At Redwood, we always attempt to turn around deals within 48 hours from receipt of full information base. The disadvantages of debt: need to build up a debt repayment profile into the business model and consider impact on cash flow. And even interest-only payments may be tough in periods of growth or startup. The other thing to think about, disadvantage of debt, is that you will probably have to give PGs, personal guarantees, or use assets as collateral. And the level of funding is likely to be limited by the asset base of the business or the earnings. E.g., if you're a fast-growing technology company that's asset light but loss-making, generally banks are unlikely to lend, even though you may exhibit an attractive growth profile. So which way do you go? Why, what, when? What's the purpose? Consider the purpose of what you're raising the cash for. If it can be purely funded by an asset funder, for example, say for your own property purchase, something Redwood would probably do, or a lease arrangement for equipment, that's probably the best way to fund it. You can obtaining asset finance is a simple way for a business to fund it. Is it a strategic change that you're looking to fund? Possibly R&D, possibly growth through investment, and that may be things like training, bringing in more capability into the business. Then perhaps you might have to think elsewhere than pure debt. You know, think about when you need it, short or long term, and clearly that's going to be driven by affordability and repayment. Time, how much have you got time to actually spend looking around for investment? And flexibility. Debt capacity is always going to be there's always going to be finite based on that repayment ability of debt and the availability of security. Bluntly, if you have an asset, property or equipment or kit, you are likely to be able to pawnbroke that, but that may not be the best way and in the best interest of your business, and could also be costly, particularly if you're not in a position that you can put a standard package together. Next slide, please, if I may. What do you want from an investor? I think as a business, you need to really sort of step back and think, what do you want from an investor? Clearly you want money. That's an obvious example. Time. Do you want their time? Do you want them to support, to be an ear, to discuss strategy and guide you? Something to think about. You might not. You might just clearly want that money. Skill, know-how. Are you looking for specific knowledge from an investor? Perhaps investors who specialize in sectors, others that bring about specific knowledge, perhaps in marketing, production, other areas of specialism. And in the future, what are you looking for? I think you need to consider how long you're looking for them to be involved. You need to give thought to this to ensure that they can at least support your short-term goals and probably medium-term goals. For example, you may have a growth strategy that may mean in 5 years, you may need further investment. If that is the case, will you be able to actually stay with that investor? Will that investor be able to support you? And indeed, if they can't, can you move on with the arrangements that you've got? Or fundamentally, do you just want to have cash and nothing else? And some investors may bring that, and some ways of getting investment might actually do that. Could I have the next slide, please? So how can an investor help? Now, this slide is pretty much the same as the previous, and it's intentional, really. Money is a tick. Yeah, an investor can help with money. They can also help with contacts. Having skills is good, but you might not have the contacts to help you get clients, to help you get production, improve production, and bring in other sets of skills into the business. short-term support as well as long-term support. What you may have to consider is how much due diligence is needed by that investor to provide that. So if you need short-term support, you might not be able to get an investor to support that. Indeed, it'd probably be more costly, and therefore looking at bank debt. Strategic guidance, input into the next stages. I know very much with historically, the old school bank managers, I was probably one of those, would discuss and challenge the business in terms of strategic. And looking at the next point, challenging the model and having a good discussion and getting the owners thinking. I certainly think that's far less now, particularly from the clearing banks. And whilst accountants will provide some of that support, sometimes they are pure auditors and don't give that practical advice. So can that investor bring more to you than just money? Worth thinking about. And it's understanding that value that they can bring. Next slide, please. Thank you. So I'm going to talk through really 4 different equity options, keeping it simple. There are different types of equity that you can have within those, but I'll keep it quite simple to friends and family, high net worth and angel investors, institution and family offices, and crowdfunding. So looking at friends and family, now the advantage of that is clearly it's less sensitive to investment terms of valuation. So you go to a friend or family, that they won't necessarily worry about the valuation. They'll be really investing in you and putting money into you, and probably can make faster decisions as they're unlikely to do any form of due diligence. And a lot of businesses grow from that type of investment. What you have to think about is that the level of funding could be limited. You could be borrowing 20, 30,000 off an aunt or an uncle who's happy to leave money in there. But if you go to the next stage, they may not be able to support. If things don't work out or go wrong, it can damage the relationship. And you need to be really clear on that and clear what you want from that investment and what they will get from that investment, how they will get repaid or the return. And I would suggest don't do loose arrangements. And Emma will talk more about the legal side of things, but it's worth getting it very much documented. Usually they're unable to provide follow-up capital, and typically unable to provide real strategic advice or introductions elsewhere. But I'm not saying they won't, but generally that's how it would probably be. We then look at high net worth and angel investors, usually probably 10, 15,000 up to probably $250,000. The advantage is that they like to be relatively sophisticated, who can provide help and advice required. I think it's about getting the personal relationship with the angel investor. They can provide increased levels of funding versus family and friends, and probably relatively limited due diligence to invest, so they can make fast decisions, certainly less than if you were looking at larger equity. The disadvantages, I think, it can be difficult to actually find an angel investor that you actually like and trust and who wants to be part of your journey, and they can be more demanding on investment terms and valuation. But having a good angel alongside you, and particularly in the early days of growth, can be absolutely invaluable. Institutions and family offices, there's a bit wide range in that, often referred to as venture capital. Advantages generally would have a network of contacts that you can leverage, vastly experienced and can provide help and support, and will be able to provide a much greater levels of funding than possibly angels. The disadvantages is that they will want to complete thorough due diligence, which could take several weeks and months. They'll be very focused on valuations and terms, which may be diluted to founders and management. And they may probably will require regular shareholder updates and reports, which can increase that workload. Excuse me. Family offices are a great source of capital, particularly if you know a family office who is experienced in a particular sector, for example. They're usually friendly to deal with, extremely helpful, and provide sufficient levels of funding. The level of expertise, though, very much depends on that family office. So you do have to make sure you find the right partner. And if you're looking to get funding from an institution, they do focus on seed capital, i.e. startups. And these investors go all the way up to what they would call Series B and beyond Series B investment. That's different levels of investment as a business grows and evolves. Returns range from startup in the region of somewhere times 7-10 times multiple return on investment over time, down to 2 to 5% return for investment on more mature businesses. And that depends, when I'm saying more mature businesses, how you've grown to a certain level of probably profitability and income generation. We then move on to crowdfunding. Relatively new. You can raise as much as a little as £10,000. You can also raise a large sum of money. Investors don't require due diligence or very little due diligence. They want to know about you and the business more. And they won't necessarily want the frequent updates, but want to know just how the business is going from time to time. Investors tend to not be focused on valuation and terms. So it's not necessarily significantly dilutive to founders and shareholders as perhaps other forms. But there are disadvantages. Investors may vary depending on the company and sector, investor appetite. Tech-focused companies tend to gain more traction in today's environment. There can be fees associated with raising on crowdfunding sites, so be aware of those. And investors will not necessarily provide any insight or expertise and may not be able to provide follow-up capital. And if you don't raise the full amount, often through crowdfunding, if you say you want to raise 30,000 and you don't get there, you won't actually get anything. Now, EIS schemes, this is just something that is worth thinking about. And there's a couple of government websites which you can look this up. The Enterprise Investment Scheme. Check if your business is eligible for the scheme. If it is, then it will make funding from an institution or high net worth and family investors typically more attractive, and also angel investors, due to the tax advantages with the scheme. 30% relief on income and exemption for CGT after 3 years, and they also get relief on losses. The company must be a permanent establishment in the UK. It's not expected to close in the short term. And the qualifying company and its subsidiaries must not have gross assets that exceed 15 million. There's a number of other categories in there, which I won't go into, but they are easily available on the internet. It must have less than 250 full-time employees. But the EIS scheme, going to an investor to say that you would fit that criteria, would be an attraction to them. There are certain businesses and sectors that can't apply, that it's not available. Including hotels, dealing in futures, production of fuel, property development or leasing, forestry, farming, and there's a number of other sectors which are it's worth looking at. But for an investor, knowing that they've got the EI scheme behind them will help. There's also something called the Seed Enterprise Investment Scheme. For less than 200,000 gross assets and less than 25 employees, and maximum funding of 150,000. Large tax breaks there for investors, and similar kind of criteria around qualifying sectors and the size of the businesses. Could I ask you to move to the next slide, please? Very briefly, top tier tips for funding, and this applies also to loans. Be transparent, open and honest. Don't have skeletons coming out later on in the relationship. Deal with professionals, have decent solicitors and accountants to act on your behalf. I think when you're negotiating with an investor, be human, be flexible. Investors will want to get on with you and fund you. And if you have a good relationship with your investor, I think that's a good way of ensuring that they understand you. Highlight the issues as well as the positives, the bumps in the road that you think you might encounter. Provide all the information that is required at the time. Try to get that packaged neatly, and also put together a business plan, which you should be doing to think about why you want the money and the direction that the business is going in, including your future strategy, perhaps product, perhaps different areas that you're looking to move into. Could I have the next slide, please? Thank you. Consider what your USP is, your unique selling point. It may be speed of delivery from a service perspective, it may be quality, it may be range. Think about how you are versus your competition in the marketplace. And certainly when you start looking at institutions will want to understand what you believe will make you succeed. Absolutely key. Experience, sell yourself. Don't undersell yourself. Give evidence of your background and experience in the marketplace and what you know. Very important when discussing with investors. Fundamentally, if they don't believe in you, it's very difficult for them to believe in your business. Have a clear business plan and strategy. Be able to be questioned on that and think about what your plan B is if X happens. Be committed and passionate. Don't underestimate that. As I mentioned previously, have good accountants, solicitors, and use chambers such as this for contacts, to talk to people, to get knowledge. Also consider perhaps whether you need a non-exec or business advisor to support you. Not necessarily somebody who's taken a share in the business, but somebody who's external, perhaps has other wider experience with wider businesses, who can come in and give a non-emotional view about your business and challenge you, possibly before going for external investment. Do understand your market though. When you are going to meet an investor, understand who your competition is, what the product's out there, what the next stage is in terms of your market. Okay, next slide, please. So that's a real whirlwind spin through of my views in terms of when you're looking for raising capital, raising investment into the business. I think for small businesses it can be daunting, but equally there are a lot of investors out there who will help you go through it. It is a bit about mindset, understanding your business and having trust in that, and knowing where you want to go. That is probably the key thing. But not being afraid to ask for support, ask for guidance and information. So that's where we are. Happy to take questions at the end. I think over to you now, Emma.
Thanks, Chris. Yeah, could my slides be uploaded now, please? Thank you. So Alison has already briefly introduced me, but just to give you a little bit more information, as Alison said, I'm a partner in the corporate team at VWV. VWV is a full service law firm. We've got offices in Watford, Birmingham, Bristol and London. I'm usually based in the Watford office, but as you can probably tell, I'm still working from home mostly, although trying to get back into the office a bit more. Because we're a relatively large firm, we do cover most areas of law that either an individual or a business would need. So we cover the areas that you'd expect, like property, employment, dispute resolution, commercial contracts, and so on. But we also have niche lawyers who specialise in more sort of esoteric areas like planning and construction, data protection and procurement. So generally speaking, we can pretty much cover whatever sort of area we need advice on. We also have a sector specialism, each of us in the firm. My own specialism is in technology and early stage companies. So when the Chamber asked us to get involved with the Entrepreneurs Foundation, it made a lot of sense for us to do that. So that's enough about me. I was going to find out a little bit about you. We've got a couple of polls that hopefully will work. The Chamber will going to upload them for us. So Georgia, if you could upload the first poll, and let's see if technology doesn't fail us. So the first question was really just to find out what stage your business is at. Chris talked about having family and friends investment, or have you got bank funding? Have you got external investment already, or actually have you got a pretty established business? So if you're happy to, if you can submit your answers, and then we can have a quick look at the results. So it's a pretty mixed, it's a half equally split really between very early stage and more established businesses, which is quite interesting actually. And the next question is probably quite apt then, because the next poll is to find out what is putting people off from having an external investment. Is it the loss of control, the potential reduction of profit share, or just actually the thought of going through the whole process? Because as Chris sort of outlined, it can be pretty time consuming. So again, be helpful to have a feel for your thoughts on that, if you don't mind submitting your answers.
It's not allowing me to click on anything.
Okay. Maybe that one isn't working then.
Ah, perfect.
Let's see if that's right. Right. And again, yeah, evenly split between loss of control and the thought of going through the process. Okay, that's really interesting. So leading into what I'm going to cover, I'm going to, if you could go to the next slide, please. So I was planning to cover investment readiness and what we mean by that. I'll touch on legal due diligence and what an investor is likely to focus on. I'll cover some sort of common pitfalls that tend to crop up on deals and give you some hints as to how to try to avoid them happening on any investment deal that you might want to do. We'll talk about the benefits of being investment ready, and then I'll finish up just by highlighting some key issues to think about on investment deals. The next slide, please. So what is investment readiness? It's really the process by which you make sure your business is ready for that due diligence that an external investor will do. And as Chris has alluded, dependent on the stage your business is at and how established it is and the level of investment that's coming in, that will dictate the extent to which due diligence is carried out. But it may well be very thorough if you're raising a decent chunk of money, and that process can really impact on the founder's day job, because you'll be having to answer lots of questions and dig out information, but all the while you're trying to run the business. And responding to the due diligence questions very often is something that can't be delegated, because the investment might be confidential, very likely will be. So it's not something you'll want employees to know about and to assist with. So it's effectively a sort of legal audit on yourself, preempting the investment process. So we'll go to the next slide, please. So the areas that an investor will focus on in legal due diligence, the financial and tax due diligence will be handled separately. But as regards to the legal due diligence, the areas we'll focus on really depend on what stage your business is at and also where the value is. So, for example, if you've got a business that's very dependent on intellectual property, there'll obviously be quite a lot of focus on that. Sometimes a business is quite early stage, they might not even have any employees. And if that's the case, then employment would be a particularly important part of the due diligence process. Something that they will focus on is the shareholdings and the structure. And actually, this is something that can cause issues quite frequently with early stage businesses. It sounds quite obvious that the investor will want to find out who holds shares and what the existing percentages are as between the shareholders. But quite often, shares haven't been allotted properly or they haven't been transferred properly, and things can be a bit of a mess. And the investors obviously have to understand who the current shareholders are and what the current shareholding split is to work out what they want to have going forward. They'll also look at contracts. So there may well be key contracts with suppliers and customers, and they'll be of particular importance, but also the standard terms and conditions that the business used can be important too. Increasingly, data protection will be focused on, especially if the business has lots of personal information, it relies on that through its business, and also information technology. So very often the investor will do technical due diligence on the IT systems themselves, because in the world we're in now, IT is increasingly important, but they'll also want to look at the legal framework underpinning any IT system. So making sure you've got the correct software licenses and so on in place as well. Next slide, please. So I said I'd sort of point out some issues that we see a lot on investment deals, especially for earlier stage businesses, but also on established businesses, not only when they're getting investment, but actually sometimes when they're being sold, when they're exiting to a third party buyer as well. Something that is an issue time and time again is when the statutory books are missing or haven't been kept up to date. And quite often when we ask clients where the statutory books are, they look quite blankly at us. And I have total sympathy for that, because very often what happens is the company's incorporated, quite often by formation agents. They provide what we call the statutory books or registers, which are effectively lists of shareholders and share transfers and share allotments. And the person whose company it is has got no idea that those are actually really important. And generally speaking, under English law, the filings that you make at Companies House aren't evidence of who the shareholders are. It's the statutory books that really evidence who holds the shares, unless you make a specific election at Companies House to hold your books at Companies House. Then Companies House is not the main evidence of your shareholders, and people very often just aren't aware of that fact, and to say understandably so. So that's something that very often you have to try and find these books or reconstitute them. And that's something to think about early on before you're raising any finance or indeed trying to sell your business. The other thing that quite often happens is that if there's been initial investment rounds, quite often friends and family put in money, as Chris has said, but there might have been agreements made along the lines of, oh, you'll always have 10% of the shares. And any new investor coming in would say, well, actually, unless these existing investors are putting further money in, they're going to have to be diluted and they're going to have to give up that right. So it's just really a warning that if you're issuing shares in any very early fundraising rounds, even if it is just to family and friends, have an eye on the future and give yourself the flexibility to issue shares to investors down the line. Another thing that happens surprisingly frequently, actually, is when shareholders just sort of go AWOL. I'm working on a matter at the moment where we're trying to tidy up some statutory books in advance of an investment. And one of the main founder shareholders actually decided to move to Hawaii about 3 years ago. He just had enough and sounds quite nice. So he sort of disappeared off into the sunset. But unfortunately, we do need to sign some stuff to rectify things that weren't done properly, when they were in an early stage and didn't have advisors on board. And luckily, we have been able to track him down. But again, it's just a warning that if you are giving shares either to founders or to employees or to incentivize other people, make sure that you have the mechanism within your company's articles of association, which will be a constitutional document that has to be filed at Companies House. Make sure that those articles have the ability for shares to be transferred back if people are no longer committed to the business and they leave. And very often you'll hear people talk about bad leaver and good leaver provisions, which will dictate the price that any exiting shareholder would get for their shares. Key customer and supplier arrangements. Again, you need to make sure they're formalized. If you are relying on those documents for your income stream, you do need to make sure they're properly documented and agreed. Terms and conditions are actually equally important, because very often a company will be contracting day to day. They'll have their standard T's and C's in the back of an invoice. And if there's an issue with those terms and conditions, then it will become systemic, because you're contracting with repeated people on those terms and conditions. So get the terms and conditions reviewed, make sure they're fit for purpose, and also analyze how they're actually used, because sometimes what can happen is you think you're using your own terms and conditions, but actually the company you're contracting with has their terms and conditions, and it's not clear whose terms and conditions trumps the other. So you can end up in this situation that lawyers call battle of the forms, which sounds more exciting than it is, but yeah, that's the issue there, where you're not sure whose terms and conditions actually apply. Another thing that happens surprisingly frequently is when the intellectual property isn't actually owned by the company. That can frequently arise because at an early stage, you might have got a friend to create some software, for example, or design a logo, or there might be actually more detailed things like design rights or patents, but they're not actually owned by the company. So you need to make sure that any intellectual property is assigned to the company or licensed to the company so that they've got the right to use it. As I say, that sort of crops up a lot. And something to bear in mind is that a consultant will not, by way of their consultancy agreement, they're very likely not to automatically transfer IP to the company. So that's something you need to bear in mind if you're using consultants to help you out. And talking about consultants, the other thing an investor is likely to look at is the employment status of people helping you. At an early stage, that might not be clear. You might be reliant on people doing bits and pieces for you. But as the business develops, if somebody sort of ticks the boxes for being an employee, so basically works only for that particular company, is under the direction of that company that can dictate how they carry out the job, then they're likely to fall into the category of an employee. And that would mean that employment law rules would apply to them by default. So things like national minimum wage, entitlement to holiday, that would all start to apply. So that's the sort of thing from an employment perspective that an investor is likely to focus on. Because obviously if they're entitled to holiday pay and they've not been paid it, then there's going to be a liability sitting there. Oh, next slide, please. So the benefits of doing an investment readiness exercise are that it allows you to identify and rectify the type of issues that I've just mentioned. You've got the time to do it. You can do it, not in a massive rush. You can do it properly. It means that the valuation's likely to be maintained because investors, or equally a buyer, if you're looking to sell your business outright, they're less likely to find issues to discount or chip the price. The deal's less likely to abort because you'll have dealt with issues up front. And also psychologically, it gives you confidence in your negotiations because you can be comfortable that there's no sort of skeletons in the cupboard. But on the most basic level, it helps you to compile those key documents so that when you're asked for them, you can provide them quickly and in an efficient manner. And it gives a really good impression to any investor if you can do that. And conversely, if you can't do that, it can give a really bad impression. So you might have the best business plan in the world and the best business idea in the world, but actually, if you can't provide documents in an orderly fashion and your key contracts haven't actually been signed, that's not going to be a very good way to try and attract an investor. Next slide, please. So just a couple of issues to work through on investment deals. As a founder, you're likely to have to give what we call warranties to any investor. And that's effectively statement about the business promising that it is what they would like it to be. So there aren't any disputes, the contracts are properly enforced, there's no employment grievances. For example, the company owns its intellectual property, basic things that the investor can rely on so that they know that the valuation is likely to stack up. As the person giving the warranties, you'll want to make sure you've got some cap on your liability. So both in terms of how long the liability lasts for, financially, how much you've got at stake. And you might want to think of other protections, things like, well, actually, if the issue could be resolved by insurance, perhaps the insurance should pay out rather than you having to be personally liable for it. As the warrantor, you'll also do what we call a disclosure exercise, which means going through the warranties. And to the extent that you can't give any of the warranties, you tell the investor about those issues. So, for example, the warranty that there's no employment grievances, if there was some employment issue, you could disclose the facts relating to that. And that passes the risks to the investor. They can try and assess, do they still want to do the deal? Do they reduce the valuation? Do they ask for some additional protection? And in that way, the disclosure also helps the investor, because an investor would prefer to know about an issue before completion. An investment deal, the idea is that after completion, the parties work together for the greater good. An investor doesn't particularly want to find a last minute surprise the day after completion and then start that relationship by suing the founders. So in that respect, the disclosure helps both parties. An investor is likely to want to have a veto right over certain key decisions that are unlikely usually to want to be involved in the minutiae of the day-to-day affairs of the business, but key things like taking on bank debt, taking on a lease, taking on employees who are earning significant salaries, changing the business plan, all those sort of key things that really drive the value of the business, the investor would expect a veto right on. And I've talked about the good leaver and bad leaver provisions for the share transfers. So that doesn't just protect the investors, it can also protect the other shareholders and the other founders, because it means that there's comfort that you're not going to end up in a situation where key employees or other founders can leave the business but still hold on to the shares and then be awkward shareholders down the line. Next slide, please. So Chris mentioned SEIs and EIS relief. Very often investors will want that. If they want that, then part of the conditions of that relief is that the shares they get have to basically be what we call ordinary shares. So they're not entitled to have special preference rights. But if the investor is not looking to get those tax reliefs, they may well expect to rank ahead of the other shareholders as regards any sale proceeds on an exit or as regards dividend rights. And that means it can get quite messy if you've got different categories of investor. If you've got some investors who want to qualify for EIS, they would want to have these special rights. But if you've got other investors who don't want to qualify for EIS, then they may well want that preferred right. And then you need to sort of try and marry up the different classes of investor and keep them both happy on the terms of any deal. Investors will also most likely want to be protected against being diluted in any further round. So they're likely to say that if another investor comes in down the line, then the current investor has the right to participate in any further round, provided they pay. So they're not just going to get additional shares for free, they have to pay for them, but they certainly would want that ability to put in more money and maintain their percentage if need be. So I've put a note there about convertible loan notes because that's something that investors sometimes ask for. So just to explain what they are, it's effectively almost the sort of best of both worlds for an investor very often, because they can loan money to the company and dependent on the commercial terms reached, they may get an interest rate, they'll have a fixed repayment date, but also they'll have the choice to change the loan notes into shares either at their discretion or on the occurrence of a particular event. For example, if the company was sold or if it was listed. So they're almost sort of hedging their bets. They've got the loan, but actually if there's going to be value in the company, they can switch to shares. So there's typically quite a lot to look at in convertible loan notes. So if somebody offers you that, then that's definitely something you should get some advice on. And warranties I've discussed before. Now, next slide, please. So just a few final thoughts. Really, just with anything, preparation is key. Allow yourself time to prepare because there's likely to be some issues to sort out in advance of any investment. If you are thinking about issuing shares or, in fact, granting share options as well, please do take legal advice. We unfortunately do earn quite a few fees from sorting out the messes that people get themselves into. So don't let yourself be one of those people. And it really is a case of a stitch in time saves 9 when it comes to things like that. And the final point really is very, very basic. It's not legal at all. It does pay to keep your records up to date, keep copies of things. It just helps to be organised before any investment process might start. So that's my part over. So I think it's just questions now for both Chris and for me, if you've got any questions.
Thank you, Emma. That's lovely. And thanks to Chris as well. I think there was an awful lot of really useful information in both those presentations. So I hope you all found it really useful. Just before we go to questions, I just want to also bring in Colin Spiller. Colin is a board member of the Herts Chamber of Commerce, and he is an angel investor, so has his own company, Zenis. So hopefully Colin may also be able to answer any of your questions. I don't know whether I haven't seen any questions in the chat just yet. So I'm going to kick off by asking a couple of questions of Emma and Chris. Firstly, how long does it take an investment typically to get done from start to finish? I don't know if Emma wants to take that. And then Chris, what drives an investor to invest in a business?
Okay, so shall I go first then? I mean, the timings, but I guess the first point is the lawyers tend to get involved further down the line. Quite often, there'll be the commercial discussions, there'll be some financial due diligence, and the client may have engaged corporate finance advisors to help them find investment, depending on what level that they're playing at. So quite often we get involved, when the actual investment process in the broad terms is started. But from the point at which we get involved, I mean, typically from agreeing the heads of terms to actually carrying through the due diligence and agreeing the documents and getting the money in, you're looking at around about 2 months if everyone gets a move on, up to 3-4 months, I'd say would be typical. But as I say, that's when the lawyers get involved. Quite often there's been a lot of time spent before commercially. Just one thing I would say on that is that ideally, if the lawyers can be involved at the heads of terms stage, that's good, because the heads of terms set out the deal in a sort of headline way. They're not legally binding, but once they're agreed and signed, it can be quite difficult to backtrack sort of morally from them. And sometimes if we see the heads of terms and they've been signed, you think, oh no, they've agreed to give away this share right. And so what I would say is, and quite often companies are in the lucky position where they've got 2 or 3, 4 sets of heads of terms that they're looking at, and speaking for myself, but I'm sure other law firms too are more than happy to have a quick look at the different ones just to sort of help guide people through that. There's nothing worse than a client coming to you saying they've sent some heads of terms and you sort of groan when you look at what's been signed up. So that's just another thing to bear in mind as well.
Okay, thanks, Emma. Let's come over to Chris.
I mean, clearly an investor will be looking at a return and a financial gain from their investment. They sometimes, particularly when you look at angels, and I think Colin will probably be able to give a better view than me, given being active, but they may have a desire to get into a sector for a certain reason. It might be past experience, past knowledge, opportunities that they see that they feel that they could add to a business. So it's around bringing their own skills to that business and seeing where that business is positioned and their view that business can go further. And possibly also, when you're looking sometimes at institutions, they will build a portfolio in certain sectors, in certain areas that their investments have synergy with one another, and therefore the contacts that they have and the skills that they can bring to support the owners will be a bonus on top of the investment for the entrepreneur and the business itself. So a mixed view of, but let's not underestimate it, that other than probably family who want probably security of their investment, other investors will want a return. But equally, hopefully, that will drive an improved profitability and value for the entrepreneur and the business itself.
Thank you, Chris. Sorry, yes. Colin, did you want to add anything to that? Sorry.
Yeah, I'll first of all add a bit to how long does it take to raise investment. The fastest I've ever worked on a deal, I did one at the end of last year. From the time I started to the time we closed it was 6 or 8 weeks, but that was an exception that makes the rule that it takes a lot longer. And I have seen funding rounds that have taken, it might get some early money in, but to complete the funding round may take 12, 18 months. Not unusual. The biggest challenge is finding those initial investors who will validate the valuation for you and act as like a cornerstone investor. So when you're raising angel finance to find, and they're taking, maybe you're raising 250,000 and they're going to take at least 20, if not 30, 35, 40K. So it's significant. And you've done most of the negotiation about the valuation. They've probably done 90% of the due diligence anybody will ever do on the deal, any other angel investors. And they will normally negotiate the term sheet or the investment T's and C's, whatever those are going to be. And a lot of the time, angels won't bother with a term sheet. When you get into VCs, then absolutely you'll end up with term sheets, no two ways about it, because they won't take the deal forward to the investment committee and the board until they've got a term sheet agreed. They might well talk to them about it, but they won't actually take it forward for approval till the term sheet's in place. And Emma's absolutely right. Once the term sheet's in place with an institutional investor, really, really difficult to change it, because very often that's their standard term. So they're not going to change it unless you are a very hot property and you've got two or three other people. So you're in that investor's in a competition. Angels, very, very different. I can't think of any time I've only seen one deal which involves some angels, which actually made it onto Dragon's Den, and he had all 5 of the dragons wanting to invest, and he told them he wasn't changing the price, and they accepted it, and he chose the 2 he wanted. Absolute exception. I saw him pitching at an event as well, but he was an exception and doing something exception. So again, there are exceptions to all the rules, but if you are one of those exceptions, fantastic, but I wouldn't bank on it. I would say to you, from the time you say you're going to start raising funding, either angel funding or institutional venture capital funding, you're probably looking at a 12-month period, 12 to 18-month period. If you've already got relationships with potential angels or angel platforms, angel groups, you can short circuit that. And especially if you've got a strong lead investor on board, doesn't have to come from that group, but it reinforces what a great deal this is. If you've got a corporate finance house on board to do institutional money, typically for at least $1 million, if not 2, 3, 4 million, because they won't work for less, then they will short circuit it for you. But especially where they've got a good track record of raising funding, they will normally be able to do it in 3 or 4 months, maybe 5, 6 months, but they will know the investors, what they like. Chris was absolutely right. Institutional investors, any VCs, if you look on their websites, you'll see the things they invest in. There's absolutely no point in sending them something that isn't on their agenda. They won't look at it. You're just wasting your time. Angel investors are much more flexible. Occasionally you'll come across them. They might want to do fintech or sports tech, or I've come across some that like doing B2C things, others that won't touch B2C. So they all have, but the majority of them will look at deals that provide a business solution that look as though they're going to generate a return. And it's something, and most angel investors will only invest in things they can understand, and they don't have to understand the technology, but the impact on the business. So it's your job to be able to explain what the need is and how you're meeting that need and why you're going to sell to your potential customers. So, and that really makes a big difference.
Thank you. Thanks, Colin. We've got just a few minutes left, so we've got a few questions now in the chat. Just for speed, I'll read them out, and perhaps whoever can answer that would come forward. So this is from Roger. He's been advised that getting small amounts of money up to 250,000, for example, is a lot harder than a bigger amount like £2 million. Is that true? Anyone like to take that one?
I'll kick off. I certainly think if you've got a business that has a need for 250,000 and above, you're probably in a place where you've got a good solid base potentially, unless you're a startup and you're really kicking something brand new off that will be very attractive to an equity house. Otherwise, you've always got to have all the legals. So you're always going to have all the legals that Emma discussed. Whichever way you look at it, it won't be as complex possibly with angels as it would necessarily with an equity house, but you're always going to have that. I think there are opportunities, whether it is with, say, crowdfunding, whether it is with family offices, angels or family, to raise smaller amounts. If you're somebody who's done something previously, and I give an example, it may not be the best example in the world, but say David Lloyd, where you create a brand and you sell a brand, and then you come back and set something up again, you will get backers for that. So if you're looking at raising 5, 10, 20 million as a really seed capital, because of what you've done previously, there's a good chance you will get capital for that. At the smaller end, you're really looking at an investor who you need to find that niche. But crowdfunding is an alternate to that. I don't know if Emma or Colin have got a different view.
I think as we've still got some other questions in the chat, if that's all right, I'm going to move on to the next question. So this is from Leslie. Are there investors you can bring on board mainly for providing skills to the business?
Occasionally you're able to find investors, but I would say to you, that's an added bonus. You're better off finding the people that you want to approach to join an advisory board, to become a non-exec director, whatever it is, and then inviting them to join you once you found them, and then talking to them, and they will probably raise the opportunity with you about becoming an investor as well. So I would find the people first and then see if they are interested in becoming an investor if they get excited.
Great. Okay, thank you. Question here from Dean. Can I issue 15% shares to my sales director at a business value of £1,000 and then 20% to investors at a value of £750,000? You'd like to take that one?
I've got to say either Emma or Colin. I'd have a view, but it wouldn't be particularly informed.
I mean, my initial thought on that is tax, to be honest, because somebody somewhere is either getting a massive discount or paying over the odds. So particularly your sales director, if they're getting a massive discount, they're going to get an income tax charge. So I think you need tax advice on that to structure it properly.
Yeah. The other way of getting around that very quickly is set up a share option scheme. And the protection you have then is you only grant those options over a period of time, and they're only valid if the sales director is with you on exit. So if they leave before that, then they don't take the shares with them, because the challenge is if they do leave before that and they take the shares with them, you've only got 85% of the equity for yourself and future investors and other staff.
Brilliant. Thank you, Colin.
Thanks. Okay. Question on crowdfunding here from Johnny. So he's been told by numerous people that crowdfunding is a very attractive option as business valuations are much higher than traditional investment options such as angel investors and so on. Would you agree with that?
Do you want me to take that one?
Yeah, go on, Colin.
Okay, crowdfunding, totally agree. Valuations are typically higher. The challenge you've got is when you then go and raise a follow-on round, you may end up with a down round because you've raised it far too high a valuation. Second challenge with crowdfunding has already been mentioned. You have to hit a minimum target or you don't get anything, which is fine. So you can set a very low minimum target, but the crowdfunding platforms like Seedr's Crowdcube will only take you on if you've already got 50 or 60% of the funds you're looking for as a minimum already committed, because they want to be successful and show themselves to be successful. So you have to raise that money. And I have occasionally seen decks that say we're raising 100K because that's our minimum to go onto a crowdfunding platform that they'll accept, because you want to raise £200,000. So you have to have 50, 60% of what you're looking to raise already committed, so you can feed it in on the platform and it looks like you're doing really well and you get the crowd excited. Second challenge with crowdfunding platforms is you have to have your own crowd, and to actually get them excited, not just the people that are investing, and you have to have loads of news flow to be able to excite the crowd to want to look at your opportunity, because you're competing with all the other items on the crowdfunding platform. So if you are going to go for crowdfunding, I suggest you have a look at those two platforms, Seedrs or Crowdcube, and see what people are doing and the valuations they're using, because the information is there. You can sign up as an investor and get the full information. Nobody knows anything different, or just use a Gmail account to do so. That's not a problem. Yeah, the final one with crowdfunding is have a think about Kickstarters and the other one, which is gifting, where you're selling the product ahead of actually having the product. So if you are producing a consumer product, and I've seen people raise £300,000-400,000 on there, that actually gets you going by getting the cash in before you've actually delivered the product or have the manufacturing done. Can't think of it. It's Kickstarter and no, I can't think of it. There's two of them. Have a look at those two anyway.
Thank you.
Thanks, Colin. Okay, and I think we've got just one more question here. I'm aware that we are actually over time, but we'll just have this last question, which is from Dean, and that's potential investors are interested in issuance of shares after hitting certain metrics. How to calculate as we are pre-sales? Any takers on that one?
Sure.
Could you just repeat that question again? Sorry.
Yeah. Potential investors are interested in issuance of shares after hitting certain metrics. How to calculate as we are pre-sales? Would you like Dean to come on and give a little bit more?
No, I think what he's talking about is institutional investors will occasionally only release cash as you hit certain metrics, i.e. you have a certain amount of revenue coming in, certain number of customers, certain profitability coming in,
Colin,
generating cash flow.
sorry, just to stop you there, Colin. It would be, but actually, what the investors have said to us is, this is Dean from Design Abled. We've got the transparent face mask. We were speaking with you.
Yeah,
and
sure. I
Jeremy over the
remember.
months.
Carry on.
So we've now got pre-compliance for our P3 mask. So we've got all the pre-compliance that we need to sell this into the NHS and the different markets. We've got an investor group who's very interested in what we're doing. They're made two versions of the offer. One is an investment option of cash for buying part of our company, and the other option is a payment in kind. So they would provide the manufacturing, the contacting deals to get us to market. What they're saying is they kind of said, as a respect out of us, to not require shares until they have helped us hit certain sales metrics. So they would put us into distribution channels. So once we sell, for example, I know 100,000 masks, then they would want shares. I'm wondering how we calculate that, because we haven't made any sales yet.
Right. Yeah. Can I suggest we take this offline? That's
Thank you, Colin.
They dropped me an email. You got my email address.
I will do. Thank you. Thank you, everyone. It's been fascinating.
Interesting.
Thank you very much. I just want to say a big thank you to our presenters. We've got Emma Cameron from VWV and Chris Platt from Redwood Bank. Thank you so much for your time, putting your presentations together and joining us this afternoon. And thank you, Colin, for joining us and answering some of those tricky questions. So just leaves me to thank everyone for joining us this afternoon. Hope you found it useful, and we'll be uploading the presentations and the recording to the website as soon as possible. So thanks all, and see you again very soon. Thank you.
Thanks. Bye now.
Thanks a lot. Bye.
Bye.
Thank you. Bye-bye.